Let's bring in our next guest into the conversation, though, broaden things out. I want to welcome in Eddie Ghabour. He's the owner of Key Advisors Wealth Management. Eddie, thanks for being with us this morning. I'd love to just get your thoughts on how we're opening this Monday. I'm seeing the S&P and the NASDAQ both up. Dow sort of unchanged. Russell a little bit above unchanged right now. What are your thoughts as we kick off the week?
Yeah, this is a good start to the week, especially with crypto. Today, to us, crypto is kind of a leading indicator in regards to technology, and crypto had a little bit of a sell-off and some back and forth for a couple of weeks, and now we think as we head into October, we'll start going back and continuing making new highs. The interesting thing with this market to us is as we continue to make new highs on the S&P, I continue to hear a lot of narrative that is continuing to doubt this rally. And we think that this market is going to get stronger in the coming months. And this broadening out that we've been seeing for several weeks now is just confirmation, in our opinion, that the data is going to get stronger, not weaker. Because again, the market we think is forward looking, and it looks really good to see other areas other than just tech do well. So we continue to be extremely bullish, and dips we think will continue to get bought due to how so many are under positioned since this V-shape in April.
All right, so if we're going to be continuing this bullish rally that we're seeing, data's going to improve. Realistically, how high can we go, Eddie?
It's interesting. I think this market could go up at least another 20% as we look into 2026. Because overbought markets, like you're hearing now, as the market's overbought, they can get extremely overbought. And I look at this time period the same way we look at the 90s during the internet boom, except now we have the AI boom. And when you look at valuations and how stretched things got before we had the March of 2000 tech bubble burst, they are much more extended than where we are now. So I don't look at this as an overextended market. I think it can go much higher as we go into 2026. It's not going to be a straight line up. One could argue we're overbought short term and we could get some dips. But again, when you look at the dips that we've had, they have been very shallow and they've been aggressively bought. And again, I think that will be the trend. And I'll end it with, lastly, is just say, when you take a step back, you have a Fed that's going to be cutting interest rates in a non-recessionary environment when the market's at all-time highs. That's about as good of a setup as you can ask for as a bull, is to increase liquidity at a time that the economy is fine.
And you're certainly not the first guest that we've had liken this AI boost to the 90s internet boom that we saw. But the dot-com bubble burst. So do we have to be concerned about the AI bubble burst? Is that something that's on your radar?
Absolutely. There's no doubt this is a bubble, and it will get bigger in our opinion, but just like all bubbles, they will end badly. And so from our positioning perspective, the reason why we can gross up risk for clients and broaden out is we will sell. When we think that the bubble is going to pop or we feel like this party is over, we're not going to tell our clients to just ride it out, it will come back, because that could be a very ugly scenario. So we've told our clients, as bullish as we are, there will be a point in time, whether it's next year, the year after that, whenever that comes and the signals tell us, we will sell just as aggressively as we bought. And that's why buy and hold in this type of environment to us is not prudent for 100% of somebody's assets, especially if you are in the tech names, because again, to your point, this will end at some point in time.
All right, so don't buy and hold, buy the dip. What else can people do to be cautious and prevent themselves from being caught up in the bubble when it bursts?
Well, it depends on your process. If you don't have a process that gets you out, then I think you just need to be more diversified. Own gold. I think gold is an area. We've owned gold since last year. Gold has done better than the S&P in a bull market, and it's usually a safe haven. So when the bubble burst, I would imagine that you would see more money flows go to defense, and gold should do well and win there. And then just broaden out. If you're just going to buy and hold, don't just have a huge percentage of your assets in technology, because that will be the area that gets hit the hardest. So you'll want to have some defensive areas like utilities and staples and healthcare. We don't have those defensive positions right now for our tactical strategies because we are completely risk on, but we're different in the sense that we won't just buy and hold. So we don't need, in our opinion, to have all of that defense at a time when it is clearly an offensive market.
All right, so in the offensive market and tech obviously being favored, are there other sectors that you think are favorable right now that aren't in a defensive position?
Yes, we bought small caps. We've been in small caps. Small caps have quietly been outperforming the S&P over the last 3 months. We think that outperformance will continue, and that also with financials as well too, because of a lowering interest rate market environment from the Fed is a good place to be for that. And then consumer discretionary names. We've increased our consumer discretionary last week, buying the dip as we've continued to broaden out outside of just, your high flyers and the AI trade. So broadening that out into financials, small caps, and consumer discretionary has allowed us to get into things that we think are going to have a catch-up bid and outperform the S&P, and at the same time broaden out our holdings.
And so we've had a lot of discussion about small caps in the wake of the rate cut decision and, that they tend to perform better in this environment with lower rates. But in terms of investing them specifically, do you recommend doing something like an ETF to give you broader exposure or choosing specific companies that are just small cap by weight?
We prefer the ETF for our clients. We don't have to get too cute and buy individual names because they have such a high volatility. We buy individual names on the large cap side, but on the small cap, we buy the ETFs. IWM is a holding that we have for our clients. I own it myself. And that's how we're playing the small cap rally that we think will continue over through the first quarter of next year.
Well, Eddie, we appreciate you being with us this morning. Thank you so much. That was Eddie Ghabour, Key Advisors Wealth Management.